If you've been to a car dealership recently, you probably noticed two things. Firstly, the lots were a lot more full than they were this time last year. And secondly, those prices are high as hell. Welcome back to Lean on Success, where process improvement is self-improvement. My name's Ben. I'm a Lean Six Sigma Master Black Belt. And today, we're going to cover the auto loan crisis. Now, before I jump in, please hit that like button and subscribe to the channel for more content like this. All right, so here I'm showing the average selling price of new cars from 2016 up until last year. As you can see, it's not quite a hockey stick, but there's been a significant acceleration in prices. They were fairly flat going into 2018, and then you see at the start of the pandemic here in 2020, they just completely took off from us. Now that begs the question, why are these prices going up so quickly? Well, it's really a simple case of supply and demand. Now we know from basic economics that when supply of a particular good goes down, the price of that good goes up. We also know that when demand for a particular good goes up, that also drives up the price. Now, when you've got supply going down and demand going up at the same time, the prices go absolutely bonkers. Let's talk a little bit about what happened during the pandemic as it relates to automobiles. Now, we know that on the supply side, we had the shutdown for COVID. A lot of dealerships were closed, and that basically destroyed the ability for supply to be sold. What you may have also read about is something called a chip shortage. These are referring to the semiconductors that are used to power certain types of electronics in most cars. So these will be things like heated seats, power seats, certain parts of your console, your radio, etc. For many different reasons, there were major supply chain issues, and that caused the ability for manufacturers to make new cars virtually impossible. So that created a huge shortage of automobiles during the pandemic. Now, on the demand side, we had all that stimulus checks, the stimmies were hitting, right? So that meant that there were more down payments. People had more money in their pockets to go out and buy cars. Also, we saw the rise of the gig economy. So we saw a record number of people starting to do deliveries for companies like Uber, DoorDash, Postmates, Instacart. So there was a greater demand for vehicles and newer vehicles because people wanted cars to be able to support these new businesses. Now, we've talked about in a previous video how people actually are making less money today than they were 2 years ago. Wages have gone up, but inflation has gone up even faster. So people have less money in their pockets. Now, what you may have also read about is that the income tax season really wasn't hitting all that hard this year. This is one of the worst performing income tax seasons being reported by many people. So basically, folks that were waiting on that $3,000, $4,000, $8,000 refund check, those checks are fewer and further between this year. People just aren't getting money back like they used to. I think it's a lot of that has to do with people didn't realize that that stimmy money that people were getting, that actually adds to your taxable income. So that means that you're going to get a lower refund if you get refunds because you got to pay that stimmy money back. See, it was a trap. It's a trap. Thank you, General Akbar. So when people have a demand and really want to buy something, but they don't have enough money to buy it, the only way for that to be possible is through debt. And that's something that really concerns me, and what I want to focus on during this video is how out of control the debt situation is becoming, specifically when it comes to automobiles. Now, this slide shows the value of car loans originated in the United States. As you can see, we've hit all-time highs in the amount of money that's being borrowed to buy cars. Another thing I want to point out is this graph is broken down by risk score. And I've highlighted on the right the breakdown by credit score. And what you see in those red circles are what we call subprime lenders. These are people who are borrowing money for car loans that have a credit score below 620. One important thing that I want to point out is this remains the third highest volume of car loans across all of the sectors. Now, at first, that seems a little bit counterintuitive because why would you loan more money or write more volume of subprime loans, which we know are much riskier, than for people who are kind of in the middle, whose credit is, 650, up to 700. So I'm not going to cover that in detail in this video, but I do think that there is a predatory nature and how banks are seeing how they can overcharge customers that can't otherwise get financing in order to make huge profits off of them. And so that's why I think that we see this number continuing to be higher and outpacing people who have less risky credit. Now, in addition to record high volumes of amounts of financing for car loans, we also see that interest rates have completely exploded. Now, we did an earlier video on the Fed funds rate and what that impact has on the economy. You can also see that impact here. If we just look at the last 4 Marches, March of 2021 and 22, interest rates hovered around 4%. As you can see, March of this year, they're all the way up to almost 6.5%. So if you combine record numbers of car loans being written with record high interest rates, what we see is an explosion in the average car payment being made by these consumers. Now, this is a breakdown of the average car note by new car loans, used car loans and leases, and new car leases. And what you can see across 2020 going through 2022, there's been a significant increase in the amount of average car notes that people are paying on a monthly basis. Again, that's driven by record high demand along with record high interest rates. Now, all of this really triggers me personally because I've witnessed firsthand and lived through how having too much debt can really destroy your life. And it really worries me that people are borrowing at these record high rates and taking on higher and higher debt obligations for depreciating assets. It really bothers me greatly. And I'm really worried about what are the delinquency rates? Aren't people just defaulting left and right? Because we're making less money than we did 2 years ago, yet we're paying higher car notes. Let's take a look at that. So this is the percentage of auto loans that are 90 days delinquent or more going back to 2003. Now, what we see prior to the pandemic in 2019, that figure hovered around 5%. Then it dropped precipitously during the pandemic, mostly because there was a lot of forbearance going on with not only auto loan companies, but with mortgages and landlords and so forth. So we see that that rate started to come down for a few reasons other than just pandemic reasons. An additional reason why we're not seeing delinquency rates spike back up yet is that the volume of these sales are significantly higher. And I'll show you that in just a minute. So if the overall number of sales are way higher than they were pre-pandemic, well, that means that the number of people defaulting, the percentage is going to go lower. Also, longer loan payments keep the car payments down and more quote unquote affordable, which is also why we may not yet see a spike in delinquencies. So these are vehicle sales from the start of pandemic up through last summer. And I drew a red line that represents the amount of sales that happened in March 2020, right at the start of the pandemic. And what you see here, with the exception of April, which was during the COVID shutdown, we've not had a single month where sales went below where they were in March of 2020. So we've just had runaway vehicle sales in the middle of a pandemic, with people's wages going down, with chip shortages, with everything else happening. People have been going absolutely nuts buying cars. Now let's look at loan terms. Now, if we look at the percentage of used car loans that have a term longer than 6 years, so 73 months or longer, we see that it has absolutely exploded. It started at 19% pre-pandemic, and that's going all the way up to more than 30%. I cannot stress this highly enough. More than 30% of people purchasing a car post pandemic have financed it for more than 6 years. There are 7-year, 8-year, 9-year loans out there at record rates. I mean, my mind is just blown right now. I'm so triggered by people just signing up for this bondage. And for what? For a piece of metal. In the last few slides, I've basically talked about, look, record sales, interest rates are high, nobody cares. Car payments are super high, nobody cares. Everybody just wants to buy, right? So it's been a big party for the last 2 years. But in these next few slides, I'm going to show you how I think the party is about to come to an end. Let's take a hypothetical example. Let's say that in 2021, you wanted to buy a nice family vehicle, right? So you decided to buy a Ford F-150 with an MSRP of about $60,000. Now, if you have bought a car during the pandemic, what you might remember is because there was such a shortage on these vehicles, especially the very popular Ford F-150, which is the best-selling vehicle in the United States. Because of the popularity of the vehicles and how rare they were and how short supply they were, the dealers were putting markups above the MSRP for what they called market adjustments, right? So if you bought this King Ranch at $60,000, the markup was $10,000. They throw in all those other BS fees like nitrogen in the tires and all this other crap that's not any value at all. And of course, there's no down payment because YOLO, right? Why would you put money into the truck? You know, you buy the truck with somebody else's money, right? So that means that the total amount you're financing is $80,000 for this family vehicle. Now you want an 84-month term because you want to keep your payments down, right? That means that you're going to pay a slightly higher interest rate. So in 2021, 5% would have been an appropriate interest rate to pay for a person of reasonable credit, which means that your monthly car note on this nice average family vehicle is $1,238. Now, for a lot of you, that might seem like absolutely ridiculous. Like, man, you cannot be real. People are not out here with $1,000 car payments. There are whole TikTok challenges out there right now with people bragging about how big their car payment is. More than 10% of people who bought a car in the last 2 years are paying more than $1,000 a month. It's like a trend that's swept America. And I think a lot of it is many people are just resigned to the fact that, hey, it's inflation and prices are just higher and that's the way life is. And it's just going to be part of my normal life to burden myself with $1,000 car payments. So society is trying to normalize the idea that I'm going to pay a mortgage payment for a car. So as ridiculous as that sounds, this hypothetical example really isn't all that far off. So now let's get down the road. It's 2 years later and you decide, you know what? This truck's too big. I don't really need this much space. It's a gas guzzler. Or, you know, maybe I lost my job and so I would need to trade down to something that's a little bit more affordable. But you still want a nice family vehicle. So you say, you know what? I want to buy a new Toyota RAV4, right? MSRP is going to be about $35,000 for those. Now, there's still going to be some added dealer fees. They're not marking them up anymore, but they're still going to try to charge you for that BS nitrogen in your tires, right? But again, you don't put any money down because you, like most people, you ain't got no money, right? But here's the problem. You owe $66,000 on the truck you bought 2 years ago. But if you try to sell it or trade it in, the dealership's only going to give you $40,000 for it. That means that you are upside down $26,000 on this nice average family vehicle, the Ford F-150, which means if you want to buy the RAV4, you got to roll that $26,000 into the financing. So $40,000 for the car plus the $26,000 of your shortfall from your truck. That means you're financing a total of $66,000. Now, again, you try to get the 84 months because you want your car payments to be lower, right? But now you don't get that pretty little 5% interest rate that you were getting 2 years ago. Oh, no. The federal funds rate went through the roof. So now you got to fork out 8% interest. That means your monthly car note went down $100. Congratulations. You went through all of that work trading down to a smaller vehicle, and your monthly car note is still $1,132. Now, you might be looking at that example and say, Ben, those numbers aren't realistic. That scenario is not realistic. And I would actually agree with you. That scenario is not realistic, but not for the reason that you think. It isn't that people aren't going out in droves and overpaying for cars and paying markups and dealer fees and $500 to put nitrogen in the tires. People are definitely going out and doing that. What they're not doing, though, is rolling $25,000 of debt from a previous car into a new car worth $40,000. People are not doing that anymore. Why aren't they doing that anymore? Little thing we like to call LTV. So LTV stands for loan to value. It is a metric that banks use to measure the amount of financing they're going to approve on a car loan that's relative to the value of the car. Now, what was happening in 2020 and 2021 during the pandemic, because interest rates were still historically low and the Fed hadn't started raising them yet, banks wanted to extend credit to as many people as possible in order to keep up with the demand. So banks were starting to loosen their requirements as it relates to loan to value and doing riskier and riskier loans. They were lending at LTVs of 150 or more. So here's what that means. If you were trying to buy a car for $40,000, you could get approved for up to 150% of the car's value. In this case, that would be $60,000 to accommodate any type of upside down trade, any of these pesky dealer markups, etc. Banks were saying, hey, no problem. You're buying a $40,000 car. We'll finance you for $60,000, $65,000, $70,000. And people are happily taking these loans because they really wanted the car. However, what we're seeing now is that banks are starting to tighten their LTV requirements. The primary reason they're doing this is that the interest rates are much higher than they were 2 years ago. That means it costs more money for the banks to trade the money that they have to make money off of it. So higher interest rates means smaller profits for the banks. Also, higher interest rates means greater risk. Right? Because if the bank is starting to pay more and having to borrow more money at higher interest rates, that means that their exposure in terms of people not paying back or being able to recoup profits from the money they're borrowing, the risk of that is much greater. So what's happening is that people are starting to get stuck in these bad loans because the banks are tightening their LTV requirements. So you can't roll that $26,000 into a $40,000 car anymore because it doesn't hit the LTV requirements. So what happens? You're going to be stuck in these terrible loans, right? Now, what we've already been seeing is that normally you get 90 days behind, the bank's just going to come like a thief in the night and take your car from you in a repossession. But what we started seeing is banks are starting to extend grace periods. They're willing to work more with the customers that are behind to try to get them caught up. Now, why are banks being nicer? Why are they more willing to work with people who are behind? Is it because they've got a heart and they care about the American people and they're really just trying to cut people a break because they know how hard it is out here for a pimp? Hell no. These banks know that if you're sitting on an F-150 and you owe $66,000 on it, they know that best case scenario, if you trade it in, you're only going to get $40,000. So if they repo it from you because you can't make the payments anymore, the bank isn't going to get anywhere near $40,000. They've got to take it to an auction. The car is going to be branded as a repossession. People know that many of those cars are in terrible condition because when people can no longer afford to pay their car payments, they're not going to keep up the maintenance. They're not going to wash it. They're not going to take care of it at all. So the bank knows you owe $66,000. If they take it to auction, they're lucky if they get $30,000. So the bank is going to lose $36,000 on that truck. So what do you think the bank is going to choose? Are they just going to sign up for that $36,000 loss by snatching the truck back from you? Or are they going to work with you to pay it a little bit longer until those numbers get closer together? Now, what does all of this mean? How can we use this information to better ourselves? One thing I would say is that if you're currently behind, significantly behind on an auto loan, banks right now are more lenient than they normally would be in terms of setting up payment plans and working with people that are behind. So it is likely that you're going to have more success than you ordinarily would trying to get a bank to work with you on your auto loan. So for the majority of you, if more people get stuck in these bad loans, that's going to lower demand, because that means that those people will not be able to buy new cars. Lower demand means that inventory, which is already building pretty significantly on these car lots, will only go higher. As inventory gets higher and higher, that's going to drive prices down lower. So what I predict with all of these different factors, that starting this summer, we're going to see a pretty significant decline in car prices. And if you're in the market for another vehicle, I believe that this summer is going to be a good time for you to cash in and get a good deal. Did you find any of this interesting? Did I completely bore you to death? Did I get something horribly wrong? Let me know down in the comments and share this video with your friends. Until next time.